Yeah. So, Ken Carson dropped, and pretty banger track if you ask a guy like me, pretty banger track. I had to take the top ones out just because I'd be having a lisp with like both of them. Even the bottom one is pretty bad, but not as bad as just the top one. Yeah, I'm gonna take the bottom one out too. But that shit's a flex though. Alright, but well. Have y'all ever piped like that? Where you're just like, or you're just, should be uncomfortable. No wonder people be saying they last like 2 hours. If I was doing that shit too, I would last 2 hours instead of 2 minutes. You know what I'm saying? But, you know, it is what it is. Let's get into this. Okay, so today we're going to be talking about inverse fair value gaps. I wanted to make this video kind of going over everything about inverse fair value gaps, how I treat them, what they are, and how we can use them within our strategy or just within the charts alone to help identify where price is going. Because for the most part, a lot of people, they really only look at confluences as just things that are like, hey, when can I enter? Or how do I use this to enter into a trade? Everybody's just looking to fucking enter trades. And that's not what trading is about. Trading is about being able to be on any time frame within any second or minute of the day to be able to identify where price wants to go. So if I'm on the daily time frame, I should be able to identify where price wants to go. If I'm on the weekly time frame, I should be able to identify where price wants to go. If I'm on the 4-hour time frame, I should be able to identify where price wants to go. That's all trading is. When most people are just like, this plus this equals this, how can I enter, how can I make money? And that's not a good way to approach trading. The best way to approach trading is how can I accurately predict where price wants to go at all times and points within the day on several different time frames. So hopefully this lesson will help you guys out. Again, we're back on the YouTube grind. I'm literally going to be trying to make videos for you guys every fucking day. As long as my thumbnail guy can keep up with the pressure that we're putting into this cooker, okay? And again, the videos aren't going to be crazy long. I know we're already like 5 minutes into this bitch, but that was just because I was tweaking and showing you guys how to hit the angles right. Okay, so we'll start off. Inverse fair value gaps, IFVGs, okay? So what do I treat these as? I pretty much treat these as equal to a break of structure, okay? Jeez, plus, come on now. I'm sweating my ass off. I'm gonna have to take off this t-shirt pretty soon. You guys can see my gooch sweat, pretty lethal. But inverse fair value gaps, I pretty much equate these to break of structure before break of structures even happen. Okay, so let me try and find a good example of this. Did we get one here? No, not quite. This is a great example. Okay, so right down here, I don't know why my screen's lagging, but probably too much shit going on in the back rooms. Let me close this down, see if that frees up more space. But anyways, we have a bearish fair value gap. Hold on. Let me first teach you guys what the fuck these things are. First of all, if you guys haven't seen the boot camp or the trading transformation, watch it so that you guys can see kind of what an inverse fair value gap is and also what a fair value gap is, because I'm not going to go over and cover what a fair value gap is. I'm just assuming that you guys already know because I have like 10 plus videos on that. Okay, but an inverse fair value gap is literally just a fair value gap that gets disrespected. So it's going to look something like this. Okay, so we have a candle right here, right? We all know how fair value gaps get formed. We got the Mona Lisa getting put up. Okay, so boom, this is our fair value gap, right? This is our imbalanced price range. A inverse fair value gap is when, and it doesn't even have to be the next candle. Okay, so this was a down candle. Let's say this is an up candle. And then this is, it's when a fair value gap gets disrespected or closed underneath. Okay, and for me, what does that tell me about price action? It tells me that bullish market structure, in that case, right, because that was a bullish fair value gap, tells me that bullish market structure is no longer holding up. Similar to how a break of structure is a break of market structure, right? So an inverse fair value gap can be treated the same way, because typically if we have fair value gaps within the market and we're bullish, let's say we have a bullish fair value gap right here, or let's do something like this. Boom, this is a bullish fair value gap and we close underneath it. Okay, we're assuming that bullish fair value gaps are going to hold, okay? And if they don't hold, then what is the market telling us with that? It's telling us that, hey, bullish market structure is starting to get weaker. Same thing with a break of structure. When we see a break of structure, we're seeing, okay, we're no longer in bullish market structure. It's the same thing with an inverse fair value gap. So when I see an inverse fair value gap, I treat it like a break of structure. Like I'm now trying to look for things in the opposite direction. Or I use it as kind of like a confirmation confluence. So again, if we think about my overall strategy, right, I have a bunch of different strategies and I like to put a bunch of confluences together when I'm looking for trades. But if we break it down plain and simple to just TJR strategy, we more often than not, we look for a liquidity sweep, a break of structure, and then fair value gap, order block, breaker block, whatever, okay, to get filled and then enter. So now we can look for, boom, liquidity sweep, inverse fair value gap, or break of structure, fair value gap, breaker block, order block, another fair value gap, equilibrium, enter, okay? So now let's get into identifying them. And again, if you guys know how to identify fair value gaps, this should be really easy for you guys, because they're literally, they are fair value gaps that just end up getting disrespected. So this is literally like a perfect example of what I'm looking for, okay? And this is on high time frame. So again, something that I really need you guys to understand, it's something that I really, really get super duper upset about. Something that I get really upset about when I'm teaching people how to trade is they don't understand that what the concepts that I teach them happen on every single time frame. It's not just like, oh, we're in this trend on the 4 hour, so we can only execute on the 15 minute and the 5 minute. It's like, no, if we see a liquidity sweep on the 4 hour, like liquidity sweeps happen on every single time frame, order blocks happen on every single time frame, inverse fair value gaps happen on every single time frame. Price is fractal, okay? So that in mind, like let's just use what we just talked about. What do we see? Liquidity sweep. What are we looking for next? Break of structure or inverse fair value gap. What is this? It's a bearish fair value gap that, boom, we see price invalidate it before we get a break of structure. Okay, and then from there, fair value gap getting filled. We have this big ass fair value gap. Price ends up moving higher. Okay, and that was all just done on one single time frame. Okay, and again, this isn't like a strategy video. This is a Confluence video, so I just want to show you guys how these things work. And again, I want to keep this relatively short. We're already pushing some time on here. But again, we can treat these inverse fair value gaps similar to break of structure. And again, that also means, like this, for example, we see an inverse fair value gap, right? We see price close underneath that. Does that mean we instantly just flip bearish? No. If we see a break of structure, does that mean we just instantly flip bearish? No. We have to have overall market sentiment. We have to have daily bias. I'm going to make a video on daily bias right after this one, teaching you guys how I find different ways to find daily bias within the markets. Okay, but we can see here that we have an inverse fair value gap, but does that mean we're just instantly looking for sells? No. Okay, we need it in confluence with a lot of things. Okay, so let's find another example of this happening. Here, we can use, I wanted to say that one. Let's see here. This is a good one. Okay, so what do we have right here? Did this take out these highs? No. We have this, boom, liquidity sweep. Okay, we can probably even go into the hourly and identify that a little bit more clearly. Boom, liquidity sweep. Damn, there's no fair value gap, whatever. I can just do this off the dome piece. Ready? We'll act like this is just regular market open. I'm pretty sure there was news on this day just by looking at this candle. There was. Doesn't matter. We're still gonna make it work. Okay, right here. What do we see? Liquidity sweep. Overall bias is bearish. Okay, let's just assume that that was our bias going into the day. Okay, overall bias is bearish. We see a liquidity sweep. Then, okay, let's just scale down into the 5-minute time frame. Because what? Price is fractal. Liquidity sweep. Inverse fair value gap on this candle. What does price end up doing? It starts going lower. Okay, where else can we identify this? Odds are on the 15-minute. Yeah, would you look at that? Liquidity sweep. Inverse fair value gap prior to structure being broken on the 15-minute time frame. And what does that tell us? Price wants to move lower. So again, just keeping this short and simple, I want you guys to be able to add inverse fair value gaps to help you guys identify and confirm that market is shifting structure after we get a liquidity sweep without necessarily having to wait for a break of structure. This is the main point of this video, is that you guys can use inverse fair value gaps on whatever time frame you're trying to find confirmation on. Again, because what? Price is fractal. Okay, so with that in mind, we see liquidity sweep, we see an inverse fair value gap. Even though we haven't broken structure, we can treat that as a break of structure and we can start looking for whatever else we're looking for within our strategy. Cool? Cool. Awesome. I'll show you guys a couple more examples of this and then I'll let you guys get going. Okay, let's do one on the daily time frame. Fuck it. Let's see if there's some shit going on the daily. So that would mean we have to find what, like a weekly sweep? Okay, here we go. Let's see if we have something. Weekly liquidity sweep. Damn, it doesn't look like we're gonna have anything. Damn, it filled it. God damn it. Okay, fine. Let's do daily and 4 hour. We'll look for a daily liquidity sweep. Okay, daily. Liquidity sweep right here. Scale into the 4 hour here. Oh yeah. Oh damn, it was a break of structure, but still. We broke structure and we had an inverse fair value gap at the same time. So boom, we can see price break structure, but on top of that, this is like double confirmation. We have a liquidity sweep. How do we know that price is going to change direction? Because we get an inverse fair value gap and also price broke structure. And then from there, price ends up moving lower. Okay. What's our like boom first indicator of why we would even be looking for price to move in the opposite direction in the first place? Bust down, Cardi. Liquidity sweep. Okay, and then from there, what are we looking for? We're looking for some sort of confirmation, break of structure, inverse fair value gap. We get both on this. Then what else can we be looking for? Fair value gap, this, that, boom, enter, right? That would have made you guys some serious bankage on this. Let me find one more example of this. Ooh, here, that way. That one's a little shitty. Here, we'll do one on the 1 hour. 1 hour liquidity sweep, and we'll find a 15-minute. Let's find a 1 hour liquidity sweep. Okay. Boom, we spotted this guy. Wait, was this the one that we just went over? It was. Jeez. Okay, here we go. 1 hour liquidity sweep. 15-minute. Let's scale in. Let's see if we get one prior to break of structure. We get a break of structure on the same candle. But still, that's extra confluence. What do we have here? Bearish fair value gap. We see that bearish fair value gap. Boom, get respected for a little bit. Liquidity sweep. Inverse fair value gap, break of structure on this candle. Long John Silvers to the fucking moon tops. Did this sweep liquidity? No. Oh, I know on NASDAQ that day it did. Okay, this was another one. Let's see if we have an example. Ah, damn it. 15-minute break of structure. The break of structure should be working too. But it's just giving you guys another option. I think you guys get my point now. Oh, here's one. Liquidity sweep. 15-minute scale down. Inverse fair value gap on this candle on the 15-minute prior to the 15-minute break of structure, which happens right here, would have gotten a much better entry. And if you just, and you're probably saying, well, what about this 15-minute bullish fair value gap? Well, you could have waited for that as well. Boom. This one right here. Viable options. Okay, so hopefully this video helped you guys out so you guys can now, instead of just looking for break of structure, hopefully that, again, like use these two. It's not just saying like, hey, only use inverse fair value gap, only use break of structure. I'm saying use both of them together to give yourself more options, okay? I just gave you guys a fucking crossover and now a between the legs to give you guys more options when you guys are trying to figure out where price wants to go in the long term. So that being said, I appreciate you boys. I love y'all. I'm gonna keep trying to rip out these YouTube videos for you guys.